With the S&P 500 trading right near all-time highs, and for a PE of nearly 30, it has become more and more challenging to find value in the markets. However, I am someone who believes there is always value somewhere, and every month here on my channel, I do my best to share stocks that I think are looking interesting and potentially undervalued. So in today's video, I want to share 5 stocks that I think are looking interesting. I really had to dig to try and find some new tickers, but I did find some that I think are worth sharing with you. However, before we get into the video, I am extremely excited to announce that I am going to be doing a live stream with TD on October 17th. TD invited me to be a guest speaker for their Investor Education Month, and the conversation will be centered around my process for picking high-quality stocks and how I find and analyze them. It's going to be an awesome live stream, and if you're interested in joining and showing your support, then you can sign up via the link in my description. It's completely free to do so as well. Now, with that being said, let's hop into today's video. Alright, so the first stock that I want to share in this video is the ticker symbol 4, which is the company Shift4 Payments Inc. 4 is a unique payments processing company because it offers industry-specific software solutions in addition to payments processing. It's quite literally a tech and a payments company. Now, what's interesting about 4 is Michael Burry also owns this stock, and in the most recent quarter was buying it. I also went through 4's website and found some screenshots that I think are worth sharing as well. So right here we can see that 4 says they are powering the top brands in every industry. And we can see that 4 is exposed to the travel and hospitality, food and beverage, retail, sports and entertainment, casino and online gambling, and specialty industries. They also show that they work with some of the industry leaders within each industry. For example, we can see here that 4 does work with Caesar Entertainment, and they also have hundreds of thousands of different merchants that are currently using their software and their payments platforms. One of their softwares is SkyTab, which 4 really shows off. And here they say SkyTab is more than just a point of sale system. It's an all-in-one restaurant platform that will transform your business from front of house to back of house and everything in between. SkyTab is basically a platform that helps restaurants manage their business, reservations, wait lists, online orders, tables, and also happens to take payments. The payments processing fits directly into the platform. That makes the restaurant much more efficient. And 4 says that this is the heart of their competitive advantage over their competitors within the payment processing space, is the fact that they actually have software solutions for specific industries, in addition to also having a payments platform or processing that is built into those software solutions as well. Now, this next screenshot is from the shareholder letter from the second quarter of 2024. And here the CEO says that the winners in the payment processing industry are bringing together software plus payments to deliver a more powerful commerce experience, and they can typically charge more for the value being delivered. He then continues on to say, at Shift4, more than 99.9% of our transactions are integrated into software, predominantly card present, which is not easy, and in verticals that require a lot of software to adequately serve. So over 99% of the transactions that 4 is processing are integrated onto one of their industry-specific software platforms. And this is allowing 4 to charge more money because they are essentially offering more value to their customers as well. Continuing on through the shareholder letter, the CEO writes this in regards to 4's mergers and acquisitions activity, because 4 is kind of like a serial acquirer within the payments industry as well. So he writes, "This is because we never were coddled by venture capital. We never had a Series A, B, C. We never took any outside capital for the first 15 years in the business. If we wanted to hire employees, invest in a project, or acquire an asset, we funded it with our own cash flows." So here 4 is basically saying that they have never diluted massively or taken on a lot of debt to acquire a business or fund the future of the growth. Basically, the first 15 years of the company's growth were entirely fueled by organic cash flows and profits, which is something that I do like to see. Then they say, we don't win banker auctions. We find overlooked and attractively priced assets through our own proprietary process. So 4 is not trying to be the highest bidder on whatever a bank is offering them in terms of an acquisition opportunity, but they're going out there and they're looking for overlooked and undervalued companies to acquire. And 4 actually does have a good track record of finding businesses, acquiring them for cheap prices, then revamping those businesses and getting them growing and much more profitable. Then to wrap up the shareholder letter, the CEO writes, "While I appreciate investors want simplicity, as the largest shareholder, I am highly motivated to play to our strengths and take bold, calculated risks to win." So the CEO is also the founder of the business, and he is the largest shareholder. And as we are going to see a little bit later on in this video, he's also actively buying more shares and increasing his ownership of the business, which I also do love to see. Now, getting into the most recent quarterly highlights, here we can see that Four saw 50% year-over-year growth to their end-to-end payment volume, 38% year-over-year growth to the gross profits, 41% growth to revenue, and 48% growth to adjusted EBITDA. So this company is growing extremely quickly, and this is obviously good to see. Then they show us that their Q2 end-to-end payment volume was $40.1 billion, which is up 10x from the second quarter of 2020. So they have literally 10x'd their end-to-end payment volume in just 4 years. Gross profits have also been growing extremely well over time, and the 4-year compounded annual growth rate is 62% to the company's gross profits, and the second quarter of 2024 was a major year, producing $320 million in gross profits. Net cash provided by operating activities, or operating cash flows, was also up 26% year over year and was a record quarter for the company. The next slide also shows us that Four is expecting $399 million in free cash flow for the year of 2024. And the company's free cash flows are growing quite significantly. Now, remember this $399 million in free cash flow when we start to analyze the value of this business. But moving on to the last slide that I want to show everyone, this is Four's updated full year guidance for 2024, and we can see that they are expecting end-to-end payment volume to be $172 billion, which is up 58% year over year. Gross revenue less network fees are also projected to come in at $1.38 billion, which is up 47% year over year, and organic revenue remains on track to grow well north of 25% year over year. So as I said earlier, Four does like to do acquisitions, but their business is also growing organically at a very strong growth rate of 25% plus year over year as well. So this business kind of has a two-pronged strategy, where their organic growth is very strong, but they're also acquiring businesses to accelerate growth even further. So now let's head back over to Stock Unlock, and we can see that Four is currently trading for a market cap of about $7.88 billion. So if we open up our calculator and go $7.88 billion, and we divide this by the $399 million in free cash flow that they are projecting for the year of 2024, then we get a price to free cash flow of only 19.74. This is basically 20 times free cash flow for a business that is growing its revenues by nearly 40% annually and seeing extremely strong growth to the business. And that combination of 20 times cash flows for 40% revenue growth, I do think is a pretty attractive combination. If we also take a look at the insider transactions going on, we can see that there is some insider selling, but what I do like to see is that the founder and CEO is consistently buying a lot of shares in the open market. $2 million buy here, $2 million buy here, 2.5 million, 5.7 million. So just in the past few months, they have purchased roughly $11 billion worth of shares in the open market. And again, they are the largest shareholder, they are the founder, and they are continuing to increase their position, which I do really like to see. Now, for me, I am personally not interested in buying Shift for Payments stock because I tend to stay away from the payments processing space in general, like PayPal, Visa, etc., because I don't really understand the moats within this industry. But if I did have to choose a stock to invest in, then I would definitely be most interested in Shift for Payments because they do have that software technology in addition to their payments processing, which I do think does give them a little bit of a moat. That, in combination with the incredible growth that this business is seeing, the strong leadership the insiders continuing to buy, and the not high price today, at least in my own opinion, does make this one continuing to look interesting for the month of October in 2024. All right, now let's move on to the second stock that I want to talk about in this video, which is the ticker symbol SKWD, or Skyward Specialty Insurance Group, Inc. Now, this company IPO'd in January of 2023 at about $19 per share, and since the IPO, the share price is up 120% and has massively outperformed the overall S&P 500. What's also interesting is this company is currently worth about $1.64 billion on the public stock market. So this is a smaller mid-cap company, and I don't typically share these types of businesses on my channel, but with the market being where it is, I did have to expand my search to try and find businesses that are looking truly interesting for this video. Now, Skyward Specialty Insurance is obviously an insurance business. So let's take a look into the business and why it is looking interesting. From Skyward's website, they say, "We rule our niche." Skyward Specialty is a rapidly growing and innovative specialty insurance company delivering commercial P&C products and solutions on a non-admitted and admitted basis. The company operates through 8 underwriting divisions: accident and health, captives, global property and agriculture, industry solutions, professional lines, programs, surety, and transactional E&S. So these are the underwriting divisions or the specialty divisions that Skyward likes to insure, essentially. And it sounds like they are ruling their niches and doing pretty dang well. Then Skyward says that their target business is underserved niche markets with insufficient coverage. Differentiating factors: customized products and solutions, exceptional underwriting and claims talent, advanced technology, and analytics. And the outcome of their targeted business and differentiating factors is that they are in the top quartile performance for insurance companies. So it sounds like the business is kind of building their own moat in these niche markets within the insurance industry, and they have been performing incredibly well in the insurance industry as well. Then they said that they are focused on profitable growth and strong momentum. So in 2023, they had gross premiums written of $1.46 million. And in the first 6 months of 2024, they have now written about $960 million of gross premiums. This means that Skyward is on track to write around $2 billion worth of premiums in the year of 2024, which is strong growth over 2023. Net income in 2023 was also $86 million, and so far in 2024, it is at $68 million. So net income is on track to grow roughly 50% this year. Return on equity is also strong at 19.6%, and it looks like the ROE of the business is continuing to grow. Growth in book value was 24% last year, and the growth to the book value is actually coming in slightly lower this year at only 9%, which is about 18% on a full year basis. But overall, Skyward's gross premiums written and the net income does look like it is growing quite significantly year over year. We can also see that gross premiums written grew 28% from 2022 to 2023, and in the first 6 months of 2024, they are up 22% this year. Net written premiums also grew 35% from 2022 to 2023, and so far this year, they are up 40%. So again, this company's growth is pretty dang strong, and it looks like their momentum is continuing. Now, what's also interesting about Skyward is they have a high-quality investment portfolio. Here they say that their total invested assets is $1.8 billion, and they have a 4.4% yield on those assets. We can also see that the vast majority of their portfolio is in fixed income, and they say, we continue to deploy all free cash flow into our fixed income portfolio in line with our investment strategy. Now, in my opinion, this is essentially how Skyward is balancing its risk, with that $1.8 billion investment portfolio mostly invested in fixed income or essentially risk-free assets that are yielding 4.4%, which is pure profit for the company as well. Now, if we head back over to Stock Unlock, we can see that in the first quarter of 2021, Skyward did $130 million in revenue. And in the most recent quarter, they have now done $282 million in revenue, which means that the business has more than doubled its revenue over the past 3 years, which is very strong growth for an insurance company. The company's trailing 12 months net income is also growing quite strong, and it's now sitting at $118.5 million in the past year. Now, if we take a quick look at the insider ownership, we can see that a director of the business has $118 million invested in the company, which is roughly 7% of the company as well. So there is pretty high insider ownership over at Skyward, and if you are a regular viewer of my channel, then you know that I love to see this as well. Now, if we head over to Stock Unlock's freeform tool, we can compare Skyward versus 3 other major insurance companies that I think are high-quality insurance companies. These are PGR, Allstate, and Kinsale, which I have covered on my channel before. And if we take a look at the revenue growth of these businesses since Skyward became a public company, we can see that Skyward's revenue growth so far has been 87.2%, PGR's is 42%, Allstate is 19%, and Kinsale is 126%. So Skyward is coming in second in terms of overall revenue growth since, again, the company became a publicly traded business. However, if we take a look at the price to earnings ratios of these 4 insurance companies, we can see that Skyward is the cheapest by far at a price to earnings ratio of only 13.78. Allstate has a much higher price to earnings ratio of 17.2, despite the company growing significantly slower. PGR's is sitting at 21.7, and Kinsale is selling for a price to earnings ratio of roughly 30 today. So what I'm seeing here is that Skyward is the second fastest growing insurance company out of these 4 companies, and its price to earnings ratio is the lowest by far. It also looks like it is a high quality company with high insider ownership that is also growing its net income and overall business quite rapidly. But again, its price to earnings ratio is only 13.78 today. And overall, Skyward is growing its revenue by about 38% year over year, and again, trading for a price to earnings ratio of about 13.8. So that low of a price ratio for 38% year over year revenue growth, and this business looks like its revenue is continuing to grow and its momentum is still strong. I think that makes this business overall look quite interesting. If you do dig deeper into this business, you will see that it also has low stock-based compensation, which is a green flag for me. So overall, I do think that Skyward is looking like an interesting company in the stock market in the month of October 2024, and those are all of the reasons why. Now, very quickly, I am personally not interested in buying this stock either because the insurance industry is out of my circle of competence. I have done my best to try and understand the moats within the insurance industry and really understand this business. But when I read through insurance company documents, it's incredibly dry and I feel like I'm reading an alien language. And being honest with myself, I came to the conclusion that I simply don't understand the insurance industry or these businesses. So for those reasons, the insurance industry is uninvestable for myself. But when I do take a look at Skyward's metrics, its price today, its growth, and its fundamentals, this business does have a lot going for it, and I do think that this business is looking quite interesting. All right, now let's move on to the third stock that I want to talk about in this video, which is the ticker symbol FIX, or Comfort Systems USA. Now, this one is a $14 billion company in the construction industry, and just take a look at this stock's long-term performance. So back in April of 2001, this stock was worth $1.90, and today it is now a $400 stock, which means that it is an over 200 bagger over the past 23 years now. This company's long-term growth and the management's know-how to create shareholder value has been incredible, and it looks like this business is only continuing to accelerate going forward. So now let's discuss what FIX or Comfort Systems actually does. This screenshot from FIX's own website says, "About us. Comfort Systems USA is a leading building and service provider for mechanical, electrical, and plumbing building systems. In June of 1997, the company went public with 12 operating companies. Today, we are composed of more than 45 operating companies in over 170 locations across the United States. Our tremendous growth has been accomplished by successfully expanding services to existing customers and attracting high-quality operations to our network of companies." So FIX is like a serial acquirer in the building, mechanical, electrical, and plumbing space across the United States. As they said, they went public with only 12 different operating groups, and now they have over 45. And this company uses the vast majority of its free cash flow to continue acquiring businesses and expanding and growing that way. As you can see, I do kind of like serial acquirers, especially when they have a history of deploying capital wisely in ways that actually can create shareholder value. Now, the next screenshot that FIX gives us is their construction backlog, and we can see that it has consistently grown over the past 8 years. For example, in 2016, they had a backlog of $763 million, and as of the second quarter of 2024, their backlog is now $5.77 billion, which is an increase of around 8x over the past 8 years. So their backlog of work is also continuing to grow quite substantially. Now, as I was going through FIX's investor presentation from their most recent quarter, I noticed some things that I really like as an investor. So right here they say, financial strength, positive free cash flow for 25 consecutive years, increased dividend for 12 consecutive years, debt to EBITDA of 0.13, and no borrowing as of the second quarter of 2024. So this slide tells me a few things about the business and how it is managed. Number one, this company focuses on free cash flow instead of earnings. And if you're a viewer of my channel, then you know that this is what I prefer from most businesses. We can also see that they do pay a dividend and it has been growing consistently. Their debt to EBITDA ratio is also extremely low at only 0.13. So the balance sheet of this company is very strong, which shows that the management is just managing the finances very well. And what's also interesting is this company is a serial acquirer, but it doesn't have a lot of debt, which does suggest to me that they do use cash or free cash flow to expand the business through acquisitions, which overall I do think is a good thing to see. Then finally, we can see that they have no long-term debt as of the second quarter. So again, very financially prudent business and management team. Next, we can see FIX's capital allocation. So this is where the company's free cash flow actually goes. And from 2007 to 2023, we can see that 75% of the company's cash flows went to acquiring other businesses. 14% went to share repurchases and 11% went to paying out dividends to the shareholders. So this is why I say that this company is a serial acquirer, because the vast majority of their cash flows goes to acquiring other businesses. So now let's take a look at Fix's most recent cash flow statement as well. And here we can see that stock-based compensation for the first 6 months of the year was $10 million. And last year in the first 6 months, it was $8.2 million. Now, relative to the operating cash flow that the business generates of $336.4 million, stock-based compensation is quite low. This is about 3% of overall operating cash flow, which I do think is very fair, and it's not excessive. And again, if you have been a viewer of my channel for some time, you know that I like to see businesses that are either doing no stock-based compensation or low stock-based compensation relative to the profits the business generates. And Fix does have that checkbox for me. Next, we can see that Fix's capital expenditures right here were about $50 million, which means that they have done about $286 million of free cash flow in the first 6 months of the year now. Next, we can see that cash paid for acquisitions was about $235 million. So right here, you can clearly see that the majority of the free cash flow is being used on acquiring other businesses. And again, that is how the company really does grow. And that's kind of what I wanted to point out on the cash flow statement, because they are using organic cash flows and organic profits to acquire businesses. They're not taking on an excessive amount of debt or diluting shareholders to grow the business. All right, so now let's head back over to Stock Unlock and take a look at this business's financials over the long term. So here we can see the revenue all the way back to 1997, and we can see that when there is periods of strong economic growth, like right before the tech bubble, Fix's revenue grew massively. However, after the tech bubble burst, we can see that its revenue dropped by about 50% from 2000 to 2004. Then we can see that it grew once again heading into 2008, and after 2008 during the Great Recession, revenues did drop by about 30%. However, we can see that this business's revenue is absolutely exploding and skyrocketing right now. So while the business does have a history of seeing revenue decline in recessions, right now the business's revenue is absolutely exploding. And I do think that this is because there's a lot of building going on within the United States, and there are a lot of infrastructure projects going on as well. The United States seems like it wants to reshore a lot of its manufacturing and a lot of its building, essentially. And I do think that Fix is one of the businesses that will benefit from this trend of companies essentially deglobalizing, or the deglobalization that we are seeing. I think that Fix will actually benefit. If we also take a look at Fix's operating income, it is absolutely exploding as well. In the second quarter of 2022, it was sitting at $204 million, and now it is more than doubled. It's nearly tripled to $573 million in 2 years. So this company is seeing explosive growth right now, and they're doing an incredible job. If we also take a look at operating cash flows, this is the exact same story. Cash flows are exploding, and in the trailing 12 months, they are at $723.6 million now in operating cash flow. This is the exact same story for the free cash flow, and free cash flow is now sitting at $621.6 million in the trailing 12 months now. So now let's go and talk about Fix's price today. So currently the business is trading for a price to free cash flow of 22.6, and we can see that its 10-year average is about 18. So the company is trading above its historical average price to free cash flow ratios. However, we also saw that the business's growth is accelerating massively right now. So I do think that some sort of multiple expansion is actually warranted for this business, because as we saw, revenue is exploding, operating income is exploding, and cash flows are exploding, and it seems like the trend is only continuing to accelerate. So basically, this business's growth is accelerating, and it's not trading for a significant premium over its long-term historical averages. Additionally, a 22 price to free cash flow for a business that seems to have a very strong balance sheet, a good management team, a history of doing great acquisitions, and is seeing very strong growth, I don't think is that insane. And I do actually think that this is quite a fair price for such a high quality business. In fact, we can actually take a look at Fix's long-term free cash flow growth. And over the past decade, free cash flow has now compounded at 38.6% annually, which is just insane. This is like software, high growth software company levels of growth, okay? This is faster than Microsoft, Google, Amazon, all of those companies' growth. And this is just an industrials company that is acquiring other companies with cash flows at cheap prices and then continuing to grow the business. And it is trading for a significant discount to all of those other high growth companies. Basically, what I'm trying to say is 38% annual cash flow growth for a 22 price ratio seems to be pretty reasonable. So my number one question for this business is, how likely is it that it is going to continue growing rapidly in the future? That is the number one question that I would want to ask and answer before I have the conviction to buy the stock today. But this stock checks a lot of my checkboxes when I'm looking for high quality businesses, as I have said throughout this video and this segment. So this is definitely an interesting stock that I don't think is looking overvalued today. And for those reasons, I wanted to bring it to all of your attention. All right, moving on to the fourth stock that I want to talk about in this video, which is Alibaba. Now, this is a stock that I have covered quite a bit on my channel over the past couple of years. I've also featured this one in my previous stocks to buy monthly videos, so there's not a lot of information that I haven't already discussed about Alibaba. I also recently made a full video dedicated to Alibaba and what I think about it today. So in this video, I will just give you guys some news updates because I do personally still think that Alibaba is looking cheap in the market. So the first piece of news is that Alibaba recently provided an update on its buyback program. In fact, it provided this update only 2 days ago. So right here, we can see that Alibaba bought back 414 million ordinary shares, equivalent to 52 million ADR shares, which is the US shares, at a total cost of $4.1 billion. This reflects a net reduction of 405 million ordinary shares since June 30th, or a 2.1% decrease after accounting for shares issued through the Employee Stock Ownership Plans, or the ESOP plan. What this means is that in the most recent quarter, the third quarter of 2024, Alibaba has decreased its shares outstanding by 2.1%, which on an annual basis is 8.4% of the shares are being repurchased now. So Alibaba is definitely taking advantage of the low share price or the cheap shares by buying back a significant amount of shares and returning a lot of capital back to shareholders. This is on top of the 1% dividend that the company is also paying to shareholders. So on an annual basis, through the company's profits, they are returning about 9% back to shareholders through dividends and buybacks, while also investing in the future growth of the company. And this is one of the reasons why I like when companies buy back shares at low prices, because they can get rid of or take away a lot of their shares outstanding very quickly and effectively. So I love to see that Alibaba is continuing to buy back a lot of shares while the share price is down. And I think that they're doing exactly what they should be doing while the share price is low. What I have also noticed recently with Alibaba's stock basically doubling from the lows is that a lot more investors are starting to get interested in Alibaba and Chinese stocks in general. And a lot of hedge funds are now coming out saying that they are bullish on these companies now. And one hedge fund put out this report right here. Alibaba is the largest e-commerce player in China with 40% gross merchandise volume. While the cloud computing business is relatively small, its 37% market share in China positions it well to capitalize on the increasing demand for AI-related products. In the most recent quarter, AI-related cloud revenue recorded triple-digit year-over-year growth, with the expectation that total cloud revenue will accelerate to double-digit growth in the second half of 2025. After accounting for their $60 billion net cash balance sheet, the stock is trading for 6 to 7 times earnings, which we believe is far too cheap. And this basically sums up the investment thesis on Alibaba. It is still a growing business. It has a market-leading position in the China cloud industry. It's also the largest e-commerce player in China. And when you factor out the net cash position from the balance sheet, it is trading for about 6 to 7 times earnings, which is absolutely insane. So it seems, again, like hedge funds are finally waking up to how cheap Chinese stocks were, and it seems like people are now pouring back into them. Additionally, this article right here says that cloud infrastructure service spending in mainland China grew 22% year on year in the fourth quarter, reaching $9.7 billion and accounting for 12% of worldwide cloud spending. Canalys expects growth to accelerate further in 2024, with Chinese cloud infrastructure services spending set to increase by 18% in the year. So China's cloud computing industry is growing very well. And again, Alibaba has 37% market share in this industry. I also found some longer-term projections right here from Statistica, where they say revenue is expected to show an annual growth rate between 2024 to 2029 of 20.75%, resulting in a market volume of 154 billion by 2029. And this is for the public cloud industry in China. So this market is projected to grow by nearly 21% annually over the next 5 years. And again, Alibaba has a market-leading position in this industry of 37%. So they should benefit massively from the growth to the cloud industry in China over the coming years and really over the coming decades. So in my opinion, I believe that Alibaba is set up to continue growing strong and well over the long term in China. And I think that the business's price was absurdly cheap over the past couple of years. And I do still believe that the stock is cheap today, especially when you factor in the fact that 25% of the market cap is in net cash today, which means that its enterprise value to free cash flow is still around 12 today, which is pretty low for a business with, in my opinion, a long-term growth trajectory. So for that reason, I do still think that Alibaba is cheap, and that is why it is still making it into October's stocks that are looking interesting video. All right, now let's move on to the fifth and final stock that I want to talk about in this video, which is probably no surprise to anyone because it is once again Amazon. Amazon has been featured in my monthly stocks videos for quite some time because I truly do believe that Amazon is the cheapest of the Magnificent Seven stocks. And I do still think that this stock is actually looking cheap relative to its fundamentals. So just like with Alibaba, I want to provide you guys with some new information that came out with Amazon that is increasing my conviction in this business. And I do also own shares of Amazon for full disclosure. So right here, this article says, 750,000 Amazon robots are doing the heavy lifting for our employees, so they can deliver for customers. With the latest in AI, our technology makes our sites safer and enables employee upskilling. In 2022, 1 billion packages, or 1/8 of all the orders we delivered to customers worldwide, were sorted by Robin, one of Amazon's robotic handling systems. We've become the world's largest manufacturer of industrial robots and have deployed more than 750,000 mobile robots across our worldwide operations. It's hard to believe how far we've come since the days of testing a few robots in a corner in one of our facilities. So Amazon is definitely going to be one of the beneficiaries of AI, especially if they can continue to train their robots and make their robots more efficient for their overall warehousing. And I think that Amazon is definitely one of the leaders in AI and one of the leaders in robotics. And I think that a lot of people think about Amazon in terms of like AWS and their overall e-commerce platform, but Amazon is a massive tech company. And I definitely think that if I had to pick one of the AI winners, it's going to be Amazon, in my own opinion. Recently, Amazon also announced a brand new game. So for those of you who don't know, Amazon is also trying to become a gaming company, and they are creating some pretty interesting RPGs. So on October 4th, they announced that Throne and Liberty, a massive scale free-to-play RPG, is now available on PC and console. Now, what's interesting is I went and checked out Throne and Liberty on Steam. For those of you who don't know, I am kind of a gamer. And I checked out this game. It seems like the reviews so far are mixed. And it also seemed like this was actually a $20 game. So it seems like Amazon is bringing in revenue from this game. And this is their second massive online multiplayer game. And overall, it's interesting for me to see Amazon get into the gaming industry. And it seems like they are doing their best to break into gaming. Because right now, their games are admittedly not the best, but they are still good games. But despite Amazon maybe not having the best games right now, they are making continuous improvements, learning and learning and learning, and trying to become a leader in the gaming industry. So we're going to have to see how this develops for Amazon over the longer term. Lastly, let's talk about Amazon's price today very quickly. So my favorite metric for Amazon is the price to operating cash flow. And we can see that its price to operating cash flow is about 17.7 today. And its long-term average all the way back to 2008 is about 26.7. So it is selling significantly below its long-term historical averages. To also put this in perspective, the last time that Amazon's price to operating cash flow was this low was all the way back in March of 2010, right after the Great Recession. Amazon's price to operating cash flow hardly ever gets this low. And it's kind of suggesting to me that the market is not really that optimistic on the future growth rates of Amazon's business. But I personally do think that Amazon's cash flows and profitability is going to continue growing at a faster rate than revenue as overall margins expand and as their high quality, highly profitable businesses continue to grow at faster rates than the retail business. And overall, I do think that will make Amazon's margins expand over the long term, as I just said. So to put it simply, I think that Amazon is a very high quality business with one of the best moats in the world, trading for a pretty low price to operating cash flow ratio relative to its historical averages and even relative to the rest of the Magnificent Seven. And in my opinion, it seems like Amazon is the least favorite Mag 7 stock in the market right now, but I also think that's leading it to become one of the most attractive from a valuation standpoint. So for that reason, Amazon is the fifth stock that I want to share in my October stocks video. And with that being said, that is going to wrap up the video as well. Lastly, everyone, please make sure to go and sign up for my TD live stream that I am doing. I am very excited about this opportunity to work officially with TD. I think that it's giving my name a lot of legitimacy, and it's just kind of cool to see my face on TD's website because I have been using TD as my investing brokerage for years now. So if you want to go and tune into that live stream, then please click the link in my description as it would really help me out too. And yeah, that's going to wrap up the video for today, everyone. So I truly hope that you did enjoy this video. If you did, as always, please remember to leave a like on it. And if you're new here and you want to see more stock market related content like this, then please consider subscribing to my channel as well. But with all that being said, again, thank you all so much for tuning into today's video. And I truly hope to see you all again in my next one.